What a crazy week in the markets last week. A huge amount of volatility. As a matter of fact, listen to this. The VIX spiked 136% higher in 3 trading days, which marks the third largest 3-day percent increase in history. So you might be asking yourself, what happens after this? Are the markets doomed? Yet the resilient S&P 500 is only down 5%, which represents a typical pullback. If you remember me saying to you that the S&P 500 averages 3 pullbacks a year of minus 5%. We had one in April. We have one now. And it usually takes about a month or so before it revisits all-time highs. But is it going to revisit all-time highs, or is this the start of a bear market very similar to what we saw in 2021, where the markets rallied to all-time highs? You can see the pattern is very similar. Drop to the 200 EMA, looked like it was going to bounce before then falling into a bear market. Well, lucky for you, I do have some data, and we're going to try to tackle this as best as possible. Of course, I'm not Nostradamus, but this is why we do this, in order to try to make the most informed decision with our portfolio. So let's get right into it. Now, first of all, let's discuss why the S&P 500 started this. This all happened after unemployment. The unemployment rate came in at 4.3% versus 4.1%, triggering potential recession fears because, as we know, unemployment is one of the factors that tends to unravel before a recession. You have rising unemployment as one, and then uninverting yield curves of the 10-year and 2-year, 10-year and 3-month, along with some other factors that people look at, like the SOM rule, etc. So in this case, the first canary in the coal mine for the recession fear was an unemployment that came in higher than expected, 4.3 versus 4.1%. And then the Bank of Japan decided to unexpectedly raise rates. Now, this caused not only recession fears, but fears that the carry trade is going to unwind. I'm not going to describe what that is. I did so in previous videos, so go back and watch that, or Google the carry trade if you want to know more. But essentially, we are now seeing a technical bounce. So this looks like, if you were just going to look at this and not know what happened, this looks like a technical pullback and a technical bounce. However, we have some insane events coming up that are just going to add to this volatility here. What do we have coming up? First and foremost, we have CPI. Now, I want you to think about this. If the 4.3% unemployment versus 4.1% caused a massive scare in the market, and we saw a huge rally in the VIX, I'll get to that later. And we saw a huge rally in the VIX, right? And all of these articles coming out, maybe this is the hard landing, maybe this is the black swan. What do you think is going to happen if CPI is expected to come in at 3% and it finally comes in at 2-point-something%, which would actually be the first time since April of 2021 when we were at 2.6. What a long road we've come, even though obviously there's dispute over how these numbers are calculated, but let's leave that aside for now. April 2021 was the last time inflation was at 2-point-something. So imagine this ride all the way up to near double digits, all the way back down to 3-point-something. Now we are forecast at 3%, and the release date is August 14th. Obviously, we're going to go live for that. But imagine if inflation comes in at 2-point-something%, near the Fed's target of 2%. That is just going to confirm to people that are betting that the Fed is actually going to cut in September, that is just going to confirm that the Fed actually cuts, right? They're already afraid that unemployment is coming in higher than expected, that something might break. We're starting to see an unraveling of the carry trade. Maybe something in bonds, junk bonds, etc., is starting to unravel. Maybe commercial real estate is starting to unravel a little bit, right? And so if we get to 2-point-something%, I think that will increase at least the odds that the Fed does a cut in September. Now, will the Fed do a cut in September? I don't think it's as certain as people think, right? I think that if CPI comes in at 2.9%, and I think we're going to get another CPI before the next FOMC, but if it comes in at 2.9%, I think we'll get an initial rally thereafter. But imagine it comes in slightly higher again at 3%, or if it stays in the high 2s and not back to the low 2s, then I don't think the Fed is actually going to cut in September. So there is quite a bit of complexity here, right? But I do think in the short term, if we do get to that 2 point something percent, I think that along with Nvidia earnings, which is August 28th, I do think that the market can rally in the short term back to near all-time highs until we get to that September 18th FOMC meeting. Now, we don't have an FOMC meeting in August, but there will be a clue, and that clue will come in the form of the Jackson Hole Symposium, right? That is on August 23rd, 2024. Jerome Powell is going to speak. Obviously, they're going to ask him about rates. Obviously, they're going to ask him about the CPI print that we don't know yet, but by the time it's August 23rd, he will know. And so we will get an inkling of what could happen. Now, for sure, the market is going to treat this like a Fed meeting. And for sure, Jerome Powell knows that the market is going to treat this like a Fed meeting. So if he wanted to soften the blow of what just occurred to the markets and maybe decrease some of that volatility, he could talk dovish. Obviously, he's not going to make a decision on interest rates during Jackson Hole, but he could talk dovish. He could say, yes, inflation looks really good. We are nearing the end of this. We are really, really considering cutting rates in September. He could give us a very dovish sentiment that could actually help to quell some of that volatility. Now, speaking of the crazy volatility, as I said, this set a record for the largest 3-day increase in history. However, if you look in history, a lot of these were near market bottoms for the time, right? And not even anywhere close to a bear market. 2018, 2015, 2018, 2011, 2015, 2015. We talked about this before being the last time there was turmoil in Asia. 2007 was obviously close to the 2008 financial crisis, and then you have near the pandemic bottoms, right? So spikes in volatility don't necessarily mean something bad for the market. As a matter of fact, if you look 1 year after this historic spike in 3-day volatility, we've only been red one time, which was in 2021, and we were down 2%. 2 years later, we were only red one time, and that was in 2007 after the greatest financial turmoil since the Great Depression. We were down 44%. Otherwise, this does look like a buy signal, right? Like if you were to look at the data, this actually does look like a buy signal for the midterm. Doesn't look like a sell signal whatsoever. Moreover, volatility in August is actually something that is expected, right? So if you look at here, the most volatile day each year in the S&P 500 is often in August. Now, what happens is volatility tends to mellow out. So August is not really known as a volatile month. However, the single most volatile day usually occurs in August or October. We are also in an election year. So volatility in an election year 6 months before, right, tends to see this type of spike. 6 months before election day, you tend to see a spike. This has happened in almost every single previous election. Now, is the stock market expensive historically? As a matter of fact, if you look at the forward PE, and this is before Nvidia even reports, they report on August 28th, you can see here that right now, the forward PE ratio is 20.73. This is actually below average. This is not, it shows that the stock market at current prices, at least the S&P 500, is not expensive. And typically before recessions, we tend to see a spike in forward PE. You see before 2020 it was 26. In 2008, we were in the 30s, well over where we are now. We are actually relatively and comparatively priced pretty well right now. So with that said, is inflation going to come in at 2 point something percent? Will we see a short-term rally into September? What happens in September? Is the Fed going to cut in September? As I said, I think that a lot of people's dreams are going to get crushed in September. Unless something breaks, I don't really see the Fed cutting in September. And some people are even estimating 2 cuts in September, or 1 cut of 50 basis points as opposed to the 25 basis points. I actually don't see that happening unless inflation comes in at maybe 2.5% or below, which is a tough chance. I personally think that we could see a short-term rally back to near all-time highs. Jackson Hole, we might see a more dovish Fed to try to mellow out that volatility. And then on September 18th, which is the next FOMC meeting, again, unless inflation comes in significantly lower, I don't know that the Fed can actually cut, or maybe they do a 25 basis point cut. I'm not sure. But if they do cut, I will likely exit the market, as I showed you this chart here, what happened the last couple of times after the Fed cuts, and the fact that you can actually save yourself from a 40 to 60% decline thereafter. You can see here the Fed cut in 2001, the Fed cut in 2007, near the tops of the market. So if we do get a rebound and the market starts rallying back to all-time highs, again, we're only down 5%. This is not crazy. The market starts rallying back to all-time highs, and then the Fed does a cut. That is likely when I'm going to be exiting the market. Now, I get a lot of questions from people. What do you mean exiting the market? Do you mean you're going to sell everything? Because I want to follow exactly what you do. Guys, everyone's portfolio is different, right? Like, I bought Apple for the first time in 2008. If you didn't buy Apple in 2008 and you bought it in 2024, how are our two situations different? Obviously, I'm not going to take every single thing I own and dump it and put it in cash. Like, I have some Apple that I bought at 25 bucks, right? Our portfolios are not the same. You could be older than me. Maybe you bought Apple in 1983. I don't know. You know what I mean? So it's like, make your own decisions based on this data. Don't try to piggyback off somebody or crutch on somebody and panic because you're not following their exact moves. Your portfolios are not the same. So it doesn't make sense for everyone to follow the same moves, but do what you will, whether you go into bonds or treasuries or mutual funds or money markets or CDs or real estate or gold or Bitcoin or whatever. Make your own decisions. Like, I can only do so much based on the data that I have. I try to analyze it as best as possible for you guys. I try to give you guys the best conclusions that I have at the time, but it's up to you to make whatever decisions you want based off of that. So I hope this helps. Let me know in the comment section below. Do you think that this is just a typical pullback? Do you think it's way more than that? What are you expecting from the Fed? Do you think the Fed's going to cut? Do you think they're going to cut 50 basis points? Do you think they're going to cut at all? I love to hear from you guys. Leave it in the comment section below. I try to respond to every comment. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.